Hello, Andre Garcia here. Ooh, the camera's crooked. All right, there we go. That's better, right? I don't know. I can't tell. Anyways, hi, Andre Garcia here. I am with the Growth Capital Company, and we specialize in securing loans for our clients. We work on residential loans as well as business loans and commercial real estate. So today's question, or well, not today, because I've done like 10 of these. So I guess the question of this 30-minute period is, what is a conventional mortgage loan? Okay, so conventional mortgage loan, the easiest way to describe this. Okay, there are two entities which were set up by Congress many moons ago: Fannie Mae, Freddie Mac. Okay, the point of these two institutions are to provide liquidity to the real estate market. That means that they essentially they provide money to the real estate market. Okay, that's what liquidity is. And what they've developed, in oversimplification here, what they've developed is a set of rules. Okay, and as long as a bank, let's say you were a bank, all right, you have, as a bank, let's say you have $10 million in the bank, in your bank. You know, you got $10 million that you can loan out, right? So what happens if your first deal is 15 million? Or no, well, no. Let's say you run out of the 10 million. Let's go with down to earth numbers. 300, $500,000 at a time. Some guy wants a mortgage, you give him a loan. Some other guy wants a mortgage, you give him a loan. Before long, you're gonna run out of money. So what Freddie Mac, what Fannie Mae do is that as long as lenders follow a certain set of guidelines, then the banks can turn around and sell the mortgage loan that is collected over a 30-year period. The banks can turn around and sell the loan and get more cash, so the cycle of lending can continue. So a conventional mortgage loan means that it is following the guidelines of Freddie Mac or Fannie Mae. And that means that that bank can turn around and sell it. If there is a mortgage loan that does not conform to Freddie Mac or Fannie Mae, we call that a non-conforming loan. So, for example, if you are self-employed and you have your income taxes don't show that you can afford a certain level of house, but your bank statements, we can use your bank statements in order to get you approved. We can use your bank statements and leave your tax returns out of the equation, and we get you your loan. That would be called a non-conforming loan, because in order to conform, you have to show tax returns and you have to qualify for the loan in accordance to the DTI standards, the DTI being debt to income. In accordance with the debt to income standards, you have to, check all the boxes in order to be conforming. So non-conforming is if we can't take all the boxes for you, then we go to an Alt A product or a non-conforming product. Alt A being non-conforming, Alt standing for alternative. So alternative documentation using bank statements, or using an asset depletion loan. Asset depletion loan is when, like, let's say somebody just retired, right? But they retired a little early, so Social Security doesn't kick in till next year, and they have like a period where they have a bunch of money in the bank and a 401k, they're just loaded, but they don't have any money coming in. So under conventional standards, you would not qualify for a mortgage. But if you some of these people, not a lot, but some of these people have more money in just their 401k than the loan amount that that they're seeking. You know, they got millions of dollars in the bank, 401k. They own cash. They own stock. They have like all this money, but they just want to keep everything. They don't want to liquidate any positions or whatever the case may be. They want a mortgage. So, in any case, yes, that hopefully answers your question. If you need more information, believe me, I am happy to give it to you. I can go on for hours. All right, have a great one.